Hey, folks, welcome back to the Taylor Tax Show. I'm Terrence Taylor, the co founder of Taylor Tax, and this is my partner, Big Al, and co founder. So, what's up, Big Al?
What's going on, everybody?
All right, folks, today this is episode 22, and we're going to be talking about estate planning and the tax lessons that we can learn from estate planning and sadly the mistakes that people make when they do estate planning or don't do estate planning. Episode 22 is going to look at my favorite artist, Prince. And I know that he is the favorite artist of many folks out there. So we want to take a look at how Prince went from having an estate that took 6 years to value, Big Al. And by the time it was valued in 2022, because he died in 2016, sadly, it was worth 156 million US dollars. And he ended up paying a shit ton, and that's a technical term, in taxes and legal fees on his estate to the tune of $87 million. Big Al, there's even a story that shows that the bank that was appointed to be a part of overseeing his estate, they earned $3 million before anyone who was a beneficiary of Prince's estate got any money.
That's
So
crazy. It's
let's
wild.
think about that. Let's look at those numbers. 156 million. 87 million went to taxes and legal and also, I suppose, bank fees. 3 million went just to the bank alone. And so what we want to understand is, why did that happen? So the first thing is, Prince died without the most basic form of an estate plan, which is a will. Didn't have a will. So his heirs were determined by the probate process, the courts. And the courts decided that his 6 half siblings were the legal heirs to his estate. And then therefore the estate was going to be split up equally among these 6. So there's some technical details in terms of the LLCs that they set up, but that's not as important as just understanding that Prince died without a will, and therefore his estate ended up paying 87 million out of 156 million in taxes before his heirs got any of that money. All right, Big Al, why don't you come in and share some more with us about this situation?
Well, yeah. So first of all, the first thing I was thinking about was like, did he want his 6 half siblings to all get equal amounts? Now, here's the thing: we both have kids, and clearly we don't have any favorite kids.
No.
But we got siblings and cousins, and sometimes you can have favorites. so you know, and unfavorite.
Yeah, I mean,
ones
and
as
don't
well.
tell nobody, but that's clear that not every sibling is your favorite sibling.
Exactly. So anyways, that's the estate planning is absolutely paramount. But what I wanted to lock in on is making sure that we all understood how the estate tax system works, and then what's the difference between estate taxes and inheritance taxes. Now, estate taxes are taxes assessed on the estate above the lifetime exemption for, estates, which is about $12 million as of now. Today. But when did he pass away again?
2016.
2016. And in 2017, just 1 year later, is when the Tax Cuts and Jobs Act came into play, which increased the exclusion, the lifetime exclusion, and brought it up to like 11 and some change million. But it's now. But yeah, what was it at that time though? In 2016.
Yeah, I just wanted to jump in to give you that number. Back in 2016, it was $5.45 million.
My goodness. And his estate was worth
$56 million.
So even after that exclusion, it was still over $150 million that was going to be taxed.
Exactly.
All right. So imagine this: a top level of 40% of estate taxes on over $150 million, or close to $150 million. That's a lot. All right. Now on the
that's 60 million, Big Al. I'm sorry to jump in. That's 60 million. Yeah.
By itself. And now we haven't even touched the state.
So we haven't touched the House federal. Yeah.
Now there's only 12 states in the U.S. right now that still have estate taxes.
And Minnesota is one of them.
And Minnesota's one of them. Yeah, exactly. Exactly. So that means that the state is assessing a tax. And I believe for Minnesota, it's up to 16%
Yep.
of what the estate is. And then their allowance, their lifetime exclusion was lower than what that federal exclusion was.
Yep.
So think about all that. And I believe that those estate taxes, state estate taxes added up to like another $25 million or something of that nature. On top of the 60. So it's something that you need to make sure that you are highly aware of. And once you pass or believe that you're going to surpass the value of that, matter of fact, let me look it up right now what the 2024 exclusion is. Lifetime exclusion. $13.61 million. So once you believe that the value of all your assets, and when I'm talking about the value of all your assets, I know most people don't know the day-to-day value of their business. And some might not even know the day-to-day value of multiple pieces of real estate if they're not looking to sell it at that time. But we would suggest that you get you would get your entire net worth valued every few years, if not every year, just for any eventuality, to make sure that we are doing the proper planning for you to help avoid this estate tax. Now, that's just estate tax. Let's talk about inheritance tax.
Yeah,
So
tell us about
estate
that.
tax means that the estate, which is the value of all of your possessions and properties, and that's intellectual property, physical, tangible property, and so forth, all that becomes its own estate once you pass away. And then the value of that estate is taxed up to 40% by the IRS. Now, after it's taxed and after legal fees and bank fees and creditors are all paid off, then whatever's the remainder or whatever is remaining is inherited by your heirs. All right. Now, they have this thing called an inheritance tax, whereas the heirs, if they receive a certain amount, and it depends on the state that you're in, because the IRS doesn't have an inheritance tax, they have an estate tax. States have an inheritance tax. And as we talked about it just a few moments ago, 12 states have an estate tax. All right. But the inheritance tax is a tax that the heirs have to pay on the amounts that they receive from the inheritance, which creates quite a pickle in some situations, because if they received a house as their entire inheritance, and as I say, that house was worth, or homes were worth over $5 million or $6 million or whatever the state's exclusion is, then the only options that they have are to either sell the property or finance the property if they can afford to, in order to pay off the estate or the inheritance taxes just to keep it.
Yeah.
So it creates somewhat of an undue hardship on those that are receiving the inheritance, on top of the mental and potentially spiritual anguish that they're undergoing by losing a family member. So no, I just wanted to express how that worked. The difference between estate taxes, which are charged on the federal level, and inheritance taxes, which are charged on the state level, in the unfortunate circumstance of Prince being in Minnesota, which is one of the 12 states that has their own estate tax, which was up to 16%. So all in all, I believe Prince's estate paid about 56% of the value of his estate in taxes. So out of that 156 million, only 69 million went to his heirs, and 87 million went to the IRS, the state of Minnesota, Comerica Bank, and some attorneys. Yeah.
Big Al. So here's what bugs me out. We now know, because of the space we're in as enrolled agents, tax professionals, that a lot of this could have been avoided with good estate planning. And as part of that estate planning, good tax planning, good tax strategy.
Correct.
Right? So I just want to touch a little bit on some of the things that we now know, and then I would love for you to come in and give us like some knowledge, insights on like what possible solutions folks could have and could put in place when they're thinking about estate planning. But let me talk a little bit about Prince's situation. So,
Yeah.
as we know, my favorite artist, and I never thought Prince was going to die, so I completely understand this mistake. He didn't think he was going to die either. That's why he didn't have a will,
Yeah.
right? The will in and of itself at least would have directed the estate to give his legacy, his financial resources, and any other assets that he left behind to those people who he cared about. And I want to conjecture here that one of the causes that I know was near and dear to his heart was artists being compensated fairly for their creations. So, as we all know, he went through that period where he literally changed his name to an unpronounceable symbol, and then he also ended up writing the word slave across his face, right?
Mm-hmm.
And it was all in the all aiming to help bring light to the plight of artists like him who create these amazing pieces of work, but they don't benefit as much from their creation as the record companies and folks who are in the industry, let's say. I would conjecture to say that Prince would have loved to have left some of his assets to that cause of helping artists. So had he put together a will, he could have directed how his estate was going to be split. And then he would have done well to get tax advice about how to plan his estate. Because if he had done that, he would have been taught and told about things like revocable trusts and
Mm-hmm.
putting part of his estate into revocable trusts. He would have been taught about irrevocable trusts and putting part of his estate into irrevocable trust, and even coming up with strategies of how to use the irrevocable trust to have the cash that will be needed to pay for the estate tax.
Yeah.
Right? So those are just two layers of estate planning that he could have done. And with the mistake of not even having a will, that's why it took 6 years, first of all. So imagine you're heir, and Prince did want you to get his assets, and you got to wait 6 years before you can even do anything with it.
Yeah.
It's super important that we all are aware of these things and don't make these mistakes. So let me pause here, Big Al, and hand it back over to you. Give us some insight into like what possible solutions would have been.
Well, definitely, and thanks for the explanation. The thing is that there are quite a few solutions, especially from a strategic standpoint, depending on what your goals are in life. Some people's goals are to save the wolves or wild
Yeah,
bears. Other
yeah,
people's goals are to save the planet. Other people's goals might be in legacy. Other people's goals might be in helping um, solve some sort of medical issue or something with orphans and children. But to find out what your goal is so that we can establish ways and means to fund those goals or those dreams or what your heart desires in the event, the eventuality, because it's going to happen to everybody, of your demise, whether it's timely, whatever that would mean, or untimely. Now, one of the things that we often suggest is to set up a private foundation, a private family foundation. And in doing so, you're in full control of all of the money that is donated until you pass away, and you can direct or have your board of the board of the foundation direct where the 5% that it has to be issued to a charity every year goes. And that would have immensely helped out if he systematically had a way to put in larger and larger amounts. But let's be real, he didn't expect to pass away when he did. So out of 156 million, I don't know that many people would have put 145 million in there just to make sure that the other 13 million, or at that time it was 5. So I don't know anybody would have put 151 million in a family foundation without the expectation that they're going to perish. So that could
Well,
have been one source.
Big Al, can I jump in here?
Yeah,
So
go ahead.
with the personal family foundation, he would have been capped at 30% of his adjusted gross income anyway, right?
Correct.
So
Good
yeah,
point.
yeah,
Yeah.
keep going.
Thank you. Thank you for that.
Yeah,
Yeah.
yeah,
And that's of his 30% of his annual
yeah,
income, not
yeah,
his net worth.
yeah,
So
exactly.
so if he only made, or not only, but if he
Yeah,
had made $10 million that year, he could have only put in 3 million,
that's right.
which is a drop in the bucket to the 156 million. So thank you for
Yes,
that
yeah, for sure.
clarification. The next thing is he could have started his own charity, a public
Yeah,
nonprofit,
yeah,
and made donations to that, where
yeah.
that exclusion is up to 50% of his income for the year.
Hmm.
Another thing is a charitable remainder trust. Now, with a charitable remainder trust, he could have donated large swaths of tangible property that had grown in capital appreciation over time and got the full write off of the fair market value at the time of the donation, and that could have
Hmm.
um, helped stave off quite a bit of those taxes. And then, all in all, the approach and the goal would be to systematically start giving
Hmm.
um, up to that um, lifetime amount to
Yeah.
different members of his family, because that would lower the overall estate tax as well. Now,
Hmm.
here's the other thing that might seem like a stretch, but in one of our first 3 episodes, I believe, we talked about a billionaire named Jeff Bezos that made the hard decision of moving from the state of Washington all the way to the state of California, Florida,
Yep.
in order to avoid capital gains taxes.
Mhm.
So I know Purple Rain was based on his experience in Lake Minnetonka or Lake Minnetonka,
Minnetonka.
Minnetonka, which is in Minnesota. So he had a special relationship and maybe he didn't want to leave.
Yeah.
But from a tax planning perspective, we would have still had that conversation with him
Yeah, for sure.
just so that he could make the decision and understand the opportunity costs and other cost benefits of potentially moving his tax home and
Yeah.
real primary residence to a different state.
Yeah.
So there's quite a few things that you would prepare. And
Hmm.
the last thing that I would say, because once again, it's not like he was 78 years old preparing for something to happen in the next 10 to 15 years.
Yeah.
He was relatively a young man. I forget. Do
Mhm.
you know what age he was
I
in
think he was in
2016?
his early 50s.
Well, goodness, yeah, that
Yeah.
makes a huge difference. So the last thing I'd say is to have a thing called a pour over will, and
Hmm.
with a pour over will, anything that's not already titled and funded into your trust at your death would automatically pour over into your trust to make sure that it avoids probate. So
Yeah.
we discussed on our last podcast, I believe it was Michael Jackson that had assets that were outside of his trust at the time of his death, that he had a trust but just didn't completely fund it. So with a pour over will,
Yeah.
anything that may have been outside that he may have acquired in the last 6 months or year or so would have automatically went into that trust. But yeah, so that's just some of the planning that we would suggest. Of course, it depending on his goals and his wants and desires, we could set it up and customize it just to make sure that whether it's legacy that he wanted, helping other music artists, which we know he already did, or
Mhm.
any other effort,
Yeah.
we could have directed it that way.
Yeah. And Big Al, I'm going to jump back in here and share what we shared when we started with Michael Jackson's estate. Folks, we're tax professionals, so there's a tax angle to estate planning.
Yeah.
Estate planning itself is a very specialized area that requires consultation with estate planning attorneys or those who are certified to do estate planning. It's still super important to understand, though, the strategies from a tax point of view that help with paying the taxes related to estates. And last time with Michael Jackson, I briefly touched on this strategy with revocable and irrevocable trust. And I want to just expand on that a bit because I didn't feel like I gave enough insights, Big Al, into why that's such a powerful strategy. So in Prince's case, he could have, at the stage where his estate, for argument's sake, reached $1 million, he could have set up a revocable trust where he kept, let's for argument's sake say 60.
But I found something else.
No
Sorry,
worries.
that's my Google Play.
It's all right. It's all right. You're good. So he could have set up a revocable trust where he put 60 million of that 100 million. So this is an example, right? 60 million of that 100 million in the revocable trust. And from an estate planning point of view, he could have put 40 million of that 100 million in an irrevocable trust. So when estate taxes are due, only 60 million are going to be taxed because anything that's inside the irrevocable trust is not taxed for estate planning purposes.
That's right.
Right?
Great idea. Yeah.
So that's the first thing. And then realizing that then he would have to pay federal taxes of 40% on that 60 million minus the 5.45 million. So for argument's sake, we'll make the math simple and say it's 55 million. Then he would know that he needs to be able to pay 22 million in federal estate taxes. He
That's
could
right.
then, through the irrevocable trust, take out a life insurance policy, an index universal life insurance policy that would have the death benefits of equivalent to the 22 million that he needs to be able to pay for the estate tax. And there are strategies where the funding of the premiums for that index universal life policy and the irrevocable trust can be done in such a way that his estate puts in an amount of money over a period of time, say 2 to 3 years, and then borrow against the value, the accumulated cash value in that index universal life policy to continue funding the premiums. So Big Al, he wouldn't even have to have put in, for argument's sake, 22 million of the 40 million into that index universal life policy. But that index universal life policy, IUL, would have been funded in such a way and structured in such a way that the 22 million needed to pay for estate taxes is already there. And in this example, we've just shown how an estate that's valued at 100 million, for example, can go from can reduce taxes that are payable on the estate to 22 million, and therefore 78 million of the estate is still preserved. In his case, we talked about 156 million, where only 69 million was preserved for his legacy and his heirs. So this is why tax planning, when it comes to estate taxes, is so powerful. And that's where we come in. We have expertise in tax planning, so we can certainly help in putting together tax plans for estates. And we have partners, strategic partners that have amazing strategies, such as the one I just explained, to make sure that there are ways to even fund the taxes without the estate having to put in the full amount. So
Definitely.
folks, yeah, go ahead, Big Al.
Yeah, and we don't make these decisions in silos. And I'm glad that you mentioned our strategic partners. Thing is, we have conversations with attorneys, insurance agents, real estate managers, financial managers, et cetera, to make sure that everything works out in your benefit. And just with that ingenious strategy you were talking about shifting a large amount into an irrevocable trust, could have saved him tens of millions of dollars.
78 in this case, right?
Yeah. So that was all I wanted to throw in.
Hey, appreciate you. Hey, folks, that's what we have time for. So thank you so much for listening to the Taylor Tax Show. We'll see you next time. And just to give you a preview, next time we're going to talk about Heath Ledger and the estate planning and taxes lessons from the mistake he made when it came to his estate. All right, folks. See you soon.
Cheers.